Here with the key takeaways, we've got Yahoo Finance's Ali Cannell. Ali, subscriber numbers surging. We know that's why investors are cheering on the stock today. But that price hike now, how much can they extend the runway in sub numbers?
Well, Kiko, there was a lot to be excited about in this report. Those sub numbers, as you mentioned, certainly a big catalyst there. But the price hikes that's hitting the U.S., U.K., and France, that's going to help boost margins. That's going to help boost ARM, or average revenue per member. And those were two metrics that investors were really concerned about heading into this report. But we finally have a clearer picture of what the path looks like in 2024. We got some more updates on the advertising tier, on the password sharing crackdown. So my vibe for this earnings call and the report overall is positive. I would say it's a pretty solid report, but let's tick through some of the top takeaways from the earnings call. Number one, I have to say that Netflix once again talked about the strikes. They said they are committed to ending the actors' strike, that they were in very productive talks, but then those talks broke down after the actors union really said that they want a per subscriber fee, which we know the studios cannot provide at this time. Another thing to note is on those price hikes. I mentioned how that's going to drive ARM and those other profitability metrics. ARM did decrease 1% year over year in the quarter. That was in line with company expectations, but ARM remains a metric that the company wants to continue to improve on. Those price hikes are going to significantly help with that. Another note on the password sharing crackdown is the company is, quote, incredibly pleased. You can see that reflecting in those subscriber numbers of nearly 9 million. They've taken their time with this rollout. They want to make sure they have all the pieces together, that the tech is good as well, and they can expect to continue to see subscribers climb in the quarters to come. But on the ad tier, that's something that's going to need a little bit more work. This is an area that's not fully developed. Netflix said that they are in that crawl phase and that that's going to take time to really materialize, especially as they are going after those higher ad dollars. And then with margin growth, Netflix hit 22.4% operating margin in the quarter. That's slightly ahead of its own projection. They said they do expect full year operating margins to hit 20% this year. That's the high end of their 18 to 20% range. They said that should go even higher in 2024 between 22% and 23%. But CFO Spencer Newman spoke about this on the call. So I want to play a little bit of what he had to say there.
We don't think we're anywhere near a margin ceiling. We've got a long runway of margin growth. So again, no change in our objectives, no change in our long-term margin expectations. But at our current profitability and scale, we think it's prudent to balance that historical pace of margin improvement with growth investments.
And those growth investments, that can include areas that the company is already doing, those content initiatives that they're doing both at home and abroad, also new content initiatives like gaming and their live events. So they're going to continue to balance that investment with having healthy margin growth over the long term. They didn't provide any longer term guidance beyond 2024, but they have hinted that Netflix has the potential to see margins similar to other media companies, which historically have been around the 40 to 50% range. So really something to keep an eye on moving forward. But overall, analysts have been combing through these notes. They're very bullish on the company at this point. We'll see if they can continue to hit those targets. But this really sets us up into 2024. And I'm happy that we have a clear picture. And I think investors are happy about that as well.